Hello there. Welcome to our fourth lesson on the series on Introduction to Financial Accounting. And today's lesson is about the double entry system, a very important topic on the series, a very important topic in the Introduction to Financial Accounting. As usual, you are with me, Goodstone Sjari, your online tutor. So welcome and enjoy. So what is the double entry accounting system? By now, you might have already come across this one. So in our previous lesson, we were talking about the accounting equation, which had the components of assets, liabilities, equity or capital, and we talked about the expenses and revenue. So what we said was the accounting equation forms the basis of the double entry system. So the double entry system is basically the foundation of modern accounting, requiring every financial transaction to be recorded in at least two different accounts with equal and opposite entries, which in this case will be referring to as debit and credit. So this method ensures that the fundamental accounting equation always remains balanced, as we're going to see in due course. So what are the core principles and rules of the double entry system? This is very important to master. So the double entry system operates on the principle of duality, that every account business transaction has a twofold effect, a value given and a value received. So one of the main principles of the double entry system is that every transaction affects at least two accounts. So the accounts involved can be a mix of asset, liability, equity, revenue, or expense accounts, all of which are the components of the accounting equation. So we're going to look at how every business transaction affects each of these ones. So the total debits must be equal to total credits, such that all the accounts have to balance at the end of the day. So this is a built-in check and balance system that helps in detecting errors, which means if totals do not match, an error has occurred. So the accounting equation must always balance, as we have already indicated in earlier. So this equation is the core guiding principle of the system, as we're going to see in due course. Okay, so let's now look at the type of accounts, and then we'll look at the debit or credit rules for each type of the accounts. So as earlier indicated, there are 5 primary types of accounts used in the double entry system, which are the assets, liabilities, equity, revenue, and expenses. So we're going to look at the rules, the debit and credit rules for each of these accounts. Let's start with assets. We already defined what assets are in our previous lesson. So the normal balance of assets is a debit balance. So if we are to increase the asset account, we need to debit it. And if we are to decrease it, we have to credit it. As for the liabilities, the normal balance for liabilities is the credit balance. And if we want to increase liabilities, we have to credit the liabilities account. While to decrease it, we have to debit the liabilities account. As for equity, it's the same as the you treat it the same way you treat the liabilities. The normal balance for equity or capital is the credit balance, and if we want to increase capital, we have to credit the equities account, and the vice versa when we want to decrease it. The other additional accounts are revenue and expenses. As for revenue, the normal balance for revenue is a credit balance. And if we want to increase the revenue, we credit the revenue account. And to decrease it, we debit it. As for expenses, we are going to have a normal balance of a debit. And if we want to increase it, we have to debit it and credit if we want to decrease it. So in summary, you can see that the rules apply the same for assets and expenses because they both have a normal debit balance. An increase is a debit entry and a decrease is a credit entry. And the opposite is for liability, equity, and revenue accounts. So for those of you who are very good at having abbreviations, you can use this DED for those accounts that increase with a debit entry. So debit expenses, assets, and dividends or drawings. That will help you to remember the rules. So always remember the rules. That's very important. Now moving on, now we're going to look at now the accounting cycle, a step-by-step method from the point of recording up to reporting. So the double entry system provides the data necessary to produce a complete set of financial statements through a systematic process known as the accounting cycle. So the key components include the journal entries. This is now the initial chronological record of transactions showing date, accounts affected, and amounts debited or credited, as we're going to see in due course. So the journal entries in other books are referred to as the books of original entry. It's the very initial step in the recording process. After the journal entries, we'll go to the general ledger. Now, this is a collection of all the individual accounts where the journal entries are posted and sorted by account. After entering in the individual accounts, we now have to post them in a general ledger. And from the general ledger, we have the trial balance, which is a summary list of all the accounts at a specific point in time to confirm that the total debits are equal to credits. And then after preparing the trial balance, we go now to the final part. So the financial statements. So this is the final output used by the shareholders, including the balance sheet, the income statement, and the statement of cash flows. Now, for the sake of this lesson, we are going to concentrate on the journal entries, which is the very, very beginning of the accounting process. And it's very important for you to master these rules. Okay, let's proceed. What are the advantages and disadvantages of the double entry system? So one of the advantages, as you might have noticed already, is that it improves accuracy and error detection. How does it ensure this? It's because it always ensures that every debit entry has a corresponding and equal credit entry. That way you ensure that you have recorded the amount correctly. If it doesn't balance, you are able to go back and correct. And it also provides a complete financial picture because every transaction shows all the accounts that are affected. In that way, you ensure completeness of your recording. It also facilitates the preparation of official financial statements, as we just saw in the previous slide, that without the double entry or the journal entries, there will be no proper financial statements. It forms the basis of the financial statements. It also enhances transparency and audit readiness. So the journal, the double entry system provides us with what we call an audit trail. It shows from the point of recording up to the time we prepare our financial statements. It is also preferred by the investors, banks, and tax authorities, which are all our primary users of the financial information. Now let's look at some of the disadvantages. One of the obvious disadvantages is that it's more complex and it requires accounting knowledge. That's why you are learning now, to acquire the accounting knowledge to be able to handle this double interest system. And then it can also be time consuming to maintain manually. So in an ideal situation, companies handle numerous thousands of transactions. So it will be very difficult for you to do double entry manually. That's what brings us now to the third disadvantage, which says it may require investment in accounting software or professional accountant. So this one will help to keep now the other two disadvantages. If we invest in the accounting software, it will now help us to improve our time efficiency. We'll be able to handle a lot of transactions using the system software, accounting software. And for the professional accountant, is someone who is knowledgeable about the rules of double entry system. So all these will sum up the disadvantages. So if you were to compare, you will see that the advantages of this double entry system outweighs the advantages that outweigh the disadvantages. That's why most businesses, especially those with inventory, debt, and or multiple employees, they use the double entry system for its comprehensive and accurate financial tracking capabilities. Okay, we move on. You forgive me if I'm very fast. You can always play back the video if you don't understand. I have limited time. Okay, so let's now look at some of the examples of double entry for business transactions. We're going to look at few, and then later on you can look at as many examples as possible. The first one, let's say now the owner invests cash in the business. A business owner invests 50,000 for their personal funds into the business. So this will increase the business cash, which is an asset account, and the owner's capital account. So what would be the double entry? According to the rules, an increase in asset account is a debit entry. That's why we're debiting the cash account here. And an increase in capital account is a credit entry. Okay, let's continue with our examples. So we purchase inventory on credit. So a business buys 1,000 worth of inventory from a supplier, but agrees to pay them later. So for this one, the effect is that it increases the business inventory, which is an asset, and it also increases what it owes to the supplier, which is the account payable, a liability account. So according to the rules, the double entry will be that we're going to debit the inventory account, which is the asset account, and credit the accounts payables account, liability account, with the same amount. Okay, we're simply following the double entry rules. I'll be very quick on these ones. Okay, now let's say we are paying for the inventory that we purchased on credit. So the following transaction above, the business letter pays 1,000, it owes to the supplier. So this will decrease the cash, which is an asset, and it also decreases the accounts payable amount owing to the supplier. According to the rules, a decrease in a liability account is a debit entry. That's why we're now debiting the accounts payable account. And a decrease in the asset account is a credit entry. That's why we're now crediting the cash account. Okay, there are many examples. Here we're saying goods on cash sales of goods. You debit cash, credit revenue, and like that. So let's look at the final example. Maybe we're paying rent and expense account. We debit the rent expense, and the cash is a credit because it decreases. Okay, you can do many examples as possible, as I'm showing on the screen. So that's all what double entry system is all about. Thank you for listening. This marks the end of our lesson. Thank you.